Okay, so if you step into the investment world right now, it's just charts, analyst reports, something like what, 20,000 stocks globally. It feels incredibly vast, dense,
Oh,
frankly, pretty chaotic.
it really is.
Mm.
And that's the core issue, isn't it? The common person isn't just struggling to pick a stock. They're struggling to figure out how to even begin, how to cut through all that noise, and crucially, how to make investment decisions connect back to their actual, their daily
Oh,
lives.
right. Which brings us to this concept we're diving into today. We've got this blueprint for an app idea, TradeMan.
Exactly. And it sounds pretty revolutionary, honestly. The mission here is about really democratizing investing, but not by dumbing down the market. Instead, it's about making your life, your own experience, the source of your investment intelligence.
Interesting. So cutting out the usual financial advisors, the middlemen.
That's the idea. And basing decisions on, well, three core components they identify for, like real financial freedom, they call it: time, money, and energy, the TME framework.
TME. I like that. It forces you to think about your money differently, doesn't it? Like assigning different time frames, different purposes maybe to each dollar.
Precisely. It tries to pull investing out of just abstract numbers and quarterly reports and ground it firmly in, the rhythm of your own spending, your job, your values.
Okay, so let's unpack TME. Where do we start? Maybe with the most immediate one, money.
Yeah, let's start there. Money represents the short-term strategy in this framework. And the concept here is, I think, quite clever. It's using investment not just for growth, but to sort of offset the high cost of living you feel.
Offset the cost. You mean, if I think something's expensive, I invest in the company making it.
Basically, yes. It's
Yeah.
about leveraging your own consumption data. Where do you feel pinched? Like, if you find yourself constantly complaining, oh, this quick delivery service is getting ridiculously expensive, or my ride-sharing costs are just draining my wallet.
Then the app would suggest investing in those specific companies, like a behavioral hedge.
Exactly. You're performing a personalized hedge against your own expenses. If you know from your own habits that demand for, say, Quick Deliver Co. is consistently high, even while you're complaining about their price, well, you have insight, don't you?
Hmm. Immediate insight. Before the general market analyst maybe sees the broader trend.
Right. You're offsetting the cost of being their customer by becoming, in a small way, an owner. You are the data point.
That makes sense for the short term, yeah, because our spending habits can change pretty quickly. But okay, let's be critical. For an app like Trademan to work, it needs deep data integration, right?
Absolutely.
We're talking bank statements, credit card data, maybe even real-time feeds from your food delivery app, your transport app.
Uh-huh.
How does that work with privacy? I mean, that's a massive hurdle.
It is. The source material definitely flags that as a challenge, but frames it as sort of necessary for this kind of empowerment. Assuming the regulations and user consent are there, the app needs that holistic view.
And are there models for this? Apps that already do similar things?
Well, yeah. Think about existing personal finance trackers. MoneyView, Walnut, ET Money, Monify, those kinds of apps. They already categorize your spending based on transaction data. Trademan would essentially plug into verified data like that to pinpoint those high expense areas and suggest those counter investments intuitively.
Okay, moving from complaint to capital. Interesting. Let's shift to the second pillar then, time. This is the medium-term strategy.
Correct. And this one leverages something you've likely already invested years in: your professional knowledge, your domain expertise.
So using what you know from your job.
Exactly. If you're deeply involved in a field, let's say you're a software developer working on AI infrastructure, or maybe you manage supply chains for medical devices, you're soaking up specific industry information every single day.
So the idea is if I'm, say, that IT guy, I should be looking at top stocks in that specific tech sector. But hang on, why is my knowledge necessarily better than, like, a full-time Wall Street analyst who covers tech? And isn't there a risk of this being close to insider trading?
Good questions. It's a crucial distinction. It's not insider trading because you're meant to be using publicly available market info, but filtering it through your specialized, nuanced understanding.
Ah.
The
Yeah.
institutional analyst is often a generalist, right? Covering maybe dozens of stocks across different sectors. You, the expert in your niche, you're on the ground. You might know which hardware vendor is causing headaches for everyone, or which AI trend is just hype versus which one is genuinely game-changing, maybe months before it becomes obvious in a quarterly report.
I see. So it's like informational arbitrage on public data using my specific lens.
Precisely. And because your profession or your deep area of expertise usually changes relatively slowly, maybe just a few major shifts over a decade. That justifies this medium-term horizon.
Right. It gives you a reason to hold through the smaller ups and downs.
Because you understand the fundamental direction of that industry better than most. And as the source notes, this isn't just limited to your main job.
Yeah.
You could be an accountant, but also have, like, deep knowledge of the global motorsports industry from years of following it.
Okay, so you can layer your expertise. Makes sense. Now, this third one sounds different. Energy, the long-term strategy. This moves beyond profit.
This is positioned as the real anchor, the emotional core of the TME framework.
Hmm.
Here, you invest based on your long-term vision, your values, the causes you genuinely believe in.
Sustainable farming, green energy, maybe improving local infrastructure, social causes.
Exactly. Things you have a fundamental conviction about.
The theory being, this conviction gives you the emotional strength to ride out market storms. But let it push back on that. Investing is fundamentally about return, isn't it? The source says the commitment should be so deep you'd be willing to, quote, go back and buy this company and save it for the liking of it. That sounds, well, financially irresponsible.
It's definitely a provocative statement, I agree, but I think it's meant to define the depth of beliefs required for true, long-term, values-based investing. It's not literally saying you should bankrupt yourself bailing out a company.
Okay, so what does it mean practically?
It means if a company truly aligns with your energy, your core values, you're far less likely to just panic sell when the market dips. Think about it. If you invest in green energy just for a quick profit, that's the money strategy. Price drops, you sell. Easy. But if you invest because you fundamentally believe the planet needs to decarbonize, that's the energy strategy. That underlying belief, that mission, hasn't changed just because the stock price wobbled. It helps you hold, maybe even buy more if you still believe.
I get it. It shifts the emotional focus from just the money involved to a deeper conviction in the actual product or the company's mission. That could certainly help you stay the course during tough times.
Absolutely. And your core values tend to be the slowest things to change in your life, right? Which is why this energy pillar is designed as the anchor for the long-term part of your portfolio.
Okay, so we've got time, money, energy, a framework linked to your life. But this trade man concept also seems to tackle a bigger market problem. Just the sheer complexity and jargon that puts so many people off investing entirely.
Yes, definitely. A big part of its goal is apparently to educate users, to cut through that complex web of numbers, and what the source rather bluntly calls the techno-funda and all this nonsense.
Huh. Okay, techno-funda, we should probably define that quickly. Technical and fundamental analysis.
Right. Technical uses charts, patterns, past price movements to predict future prices. Fundamental looks at the company's actual health, earnings, debt, management, its intrinsic value. Tradewin seems to want your own life knowledge, your TME insights, to sort of bypass the need for you to become an expert in those complex, often conflicting analytical methods.
And a huge part of that complexity is just not knowing what you're actually buying, right? Product misclassification.
Oh, absolutely. It's a massive issue. We've probably all felt confused by financial products pitched as one thing, but actually being a mix of others.
Can you give an example?
Well, the source points to LIC, a huge life insurance corporation, particularly in India. Most people hear insurance and think risk protection, maybe something stable like a debt instrument. But the reality, apparently, is that LIC's underlying structure is mostly equity, with debt components too.
Wow. So people buy it thinking they're getting just safety, but they're actually heavily exposed to stock market ups and downs.
That seems to be the point. They're buying into market volatility without necessarily realizing the full extent of it.
Or another example might be a major bank, like SBI is mentioned. You think bank, you think debt, maybe safe deposits.
Right, a safe harbor. But they're also deeply involved in selling mutual funds, insurance products. This lack of clarity about the actual underlying risk you're taking on when you buy a product, it's frankly terrifying. And when people get burned because they were misled about the risk category, confidence just evaporates.
Which leads us straight into the derivatives discussion, doesn't it? That seems to be where the market gets its worst reputation.
It really does. We hear that statistic all the time. 90%, maybe even more, of people who trade derivatives lose money. It's staggering.
And it's easy for the public to then paint the entire stock market with that same brush, to see all stop investing as just high-stakes gambling.
Exactly. But that's a fundamental misunderstanding of what derivatives are supposed to be for.
Okay, so what is the true purpose, according to this?
The source is really clear on this. We need to clarify their non-speculative role. The original, intended purpose of derivatives isn't just making quick, risky bets. It's primarily as a hedging instrument.
Hedging, meaning protection.
Yes, protection against equity you already hold. So let's say you own shares in a company that's your equity. You believe in its long-term future, maybe based on your energy strategy, but you foresee a specific short-term risk. Maybe a new regulation is coming, or there's market volatility expected around an election. You can use derivatives like options or futures to protect the value of those shares you hold during that risky period.
Ah, okay. So it's not gambling on price movements out of thin air. It's like buying temporary insurance on a long-term investment you're already committed to. That's a completely different framing.
A massive difference.
Mm.
And having that kind of transparency, helping users understand that distinction, is crucial for building trust. Trademan wants to make sure users see their potential short-term gains linked to their own spending changes.
Hmm.
Money, not to wild speculation and derivatives.
Okay, so this TME framework, it naturally helps with diversification too, right? Instead of just using some generic formula, you're giving your money color and purpose, as the source says.
Exactly. You move beyond those sometimes confusing rules of thumb like the 100 minus age rule for allocating between debt and equity,
Hmm.
which frankly many people find arbitrary anyway.
Yeah, I've never been entirely sure how that's supposed to work perfectly for everyone.
Right. With TME, it becomes intuitive. Your energy pillar money.
Hmm.
That's clearly high conviction, long-term equity. Your money pillar funds, maybe they start in safer debt instruments. And you use something like a systematic transfer plan, FTP, to gradually move that money into equity funds over time, specifically timed to meet a concrete short to medium term goal, like saving for a big family wedding or a down payment.
And an STP is just what?
Handle it.
A scheduled automatic way to shift money between different fund types?
Pretty much. Moving, say, a fixed amount from a liquid or debt fund into an equity fund each month. It automates the process and averages out your purchase price over time. It makes your money actively work towards a defined goal you've set.
So by linking every investment decision back to time, money, or energy, you're not just blindly chasing returns, you're building a portfolio that actually mirrors your life's different needs and timelines.
That's the goal. Money for the short term needs liquidity. Money. Investments linked to your job expertise are stable but adaptable. Time. And the investments tied to your core values need resilience. Energy.
Which brings us to the ultimate vision here, I suppose. It seems to be about creating this incredibly direct connection between you, the user, and the actual company or product you're investing in, cutting out all those confusing middle layers.
Yeah, the vision is really about transparency and maybe a kind of emotional depth in investing. The source uses examples like an investor being able to hold a stake in the actual mill that produces the rice they eat every day, or a goldsmith being able to easily hold a stock directly related to gold mining or refining.
Removing the abstraction.
Exactly. Investing in this ideal model isn't driven solely by the emotions of fear and greed around money itself, but by a tangible belief, a connection to the underlying goods, services, or mission of the company you're partnering with.
So wrapping up, we've explored this really quite radical TME framework, time, money, and energy, and how it aims to cut through the usual market chaos by grounding investment in purpose, in your purpose.
Right. And maybe a final thought for you, the listener, to consider. Think about that energy pillar. If you have an investment that's truly based on your deepest values, your vision for a better society, how far would you actually go if that company hit a rough patch? Is your commitment just about selling the stock when the price dips to cut your losses? Or is there a genuine purposeful conviction there? A belief in the mission that would make you want to stay invested, maybe even support it further beyond just the share price? That question, I think, really gets to the heart of whether you're just trading symbols on a screen or truly investing in something you believe in.